Hello and welcome to this weekly market recap for the week ending Wednesday, October 29th, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. It's a pleasure to be with all of you again this week. Well, we had another meeting of the Fed. Fed and Med met the last 2 days, started the meeting on Tuesday, ended it this afternoon. And we got another quarter point cut in the Fed funds rate down to a range of 3.75% to 4%. That was widely expected, so no big shakes there as far as the market goes. Although we did see some selling after the announcement came out at 2 p.m. But really not a whole lot different than what I think most folks were expecting. There were two folks that dissented from the vote. One was the latest addition, the President Trump appointee, who indicated he was in favor of a 50 basis point cut instead of 25. And then we had, I believe it was Jeff Schmidt, who is the Fed president in Kansas City, who said that he still thought inflation was too high to be cutting rates. He thought higher rates were better to leave it unchanged. But outside of those two, everybody else voted for that cut. So we got a quarter point cut this afternoon. That's, I think, going to be good for the economy down the road. We'll see whether or not the Fed continues to cut. I believe they will. But at least for now, we got that second cut in a row. So we definitely seem to be resuming that the rate cutting campaign that we had at the end of 2024. Normally, I would expect stocks, at least in time, to kind of rejoice that. But I think part of it is we've already seen a rally. I think the market was already assuming that this rate cut was coming. And as a result of getting it, I think we saw a little bit of sell on the news. I do believe that we will continue to see higher prices in U.S. equities. Speaking of U.S. equities, let's take a look at what happened over the course of last week. Just a quick reminder, I am looking from last Wednesday's close to this Wednesday's close. I know that's a little bit odd, but when we're doing a weekly summary in the middle of the week, that's the way we look at it. So Nasdaq 100 over the course of the last week, gaining 5%, S&P 500, 2.85%, the Dow Jones tacking on another 2.25%. Then we had the Russell 2000, just under 1.5% higher. Mid caps, 0.75%. And as you might have guessed, transports down almost 1 percentage point and continuing to lag badly. Moving on to the sectors, there was one major reason why this market keeps going up. Technology up 6.5%. This is just over the last week, 6.5%. That's almost a good annual return. But technology just continues to power forward. And the interesting part is when technology does so well, nothing else can lead the market because technology is 35% of the S&P. So when you get a lot of outperformance there, it carries the S&P 500 and everything else lags. Check this out. Every other sector underperformed the S&P 500. In fact, the S&P 500 more than doubled, or almost more than doubled, every other area of the market. Industrials, the second best area, gaining 1.45%. The S&P was up 2.85%. Again, technology literally just grabbed the market and just carried it higher with it this past week. I mean, that's the best visual I can give you. Technology is absolutely on fire. It makes sense because these technology firms are growing their earnings so rapidly, and they're doing it in an environment where rates are coming down. And when you grow your earnings rapidly, you're obviously going to have your valuations go up. The discounted cash flows are going to rise, especially when you're in an environment where interest rates are falling. So it's really a 1-2 punch right now for technology, and investors just can't get enough. Technology absolutely soaring this past week. Let's take a look at the Dow Jones. Dow Jones making a breakout above 47,000 and getting almost, actually it did get up just above 48,000 today. So very quickly, took a while to get through 47,000. Our entire lifetime to get through 47,000, but only 3 days to get to 48,000. That's how the market works when we're going up. One thing to kind of point out here with the Dow, and I talked about this fairly recently, probably in the last month or two, but we did get this breakout over 45,000. If you notice, we had an uptrend, came down, put in a left shoulder, back up to the neckline around 45,000. Lower low puts in the head, back up to 45,000, down one more time, hit that 20-week moving average that puts in that inverse right shoulder, and then we broke out above 45,000. 45,000 down to the low of the head, which is 37,000, measures 8,000 points. When you break above 45,000, that means your target, your measurement, is now 8,000 above 45,000, which makes it 53,000. I talked about this not that long ago, and today we got up over 48,000. It was also, there was a similar pattern that I talked about on the IWM, the Russell 2000, from back earlier this year, when it went up through like the 210 area and then came back down, hit that 20-day moving average. Talked about the measurement, initial measurement being up to 250, which is where we are now, or where we've been of late, up near that 250 level. Well, we got the same type of pattern here on the Dow Jones. I would be looking for this 53,000. I wouldn't be surprised if we see it within the next 6 months, maybe sooner. But within 6 months, I believe we'll have the Dow Jones at 53,000. S&P 500 making that breakout. It seems like every one of these 100-point intervals seems to come and go every week. Went through 6,700 not that long ago, 6,800 at the end of last week. Now today, hitting 6,920. We closed at 6,890, which is relatively flat. So we still haven't gotten the close over 6,900, but certainly we've had a big run to the upside, getting very close to my target of 7,000 that I set for the S&P 500 back in the first week of January. Almost there. Maybe we go up through the 7,000 level, but it certainly would seem like maybe we're poised for a little bit of a pullback, but I don't know. Hard to call a pullback when rates are coming down and earnings are going up. Nasdaq 100 outperforming all the other major indices, as I just pointed out. A big breakout here above the earlier high in October around the 25.2 level. Now up hitting 26, almost 26.2. So after breaking out, literally 4 days after a breakout above 25.2, hitting 26.2 or approaching 26.2. That's a pretty nice gain. I mean, we're talking about what, 4% or so just since breaking out, and 6% over the last week. IWM, when you look at the IWM, I've been looking at it saying, well, it's not been performing very well, but it hasn't been performing poorly. It's just that when you look at what's going on in technology and you look at what's going on in the other major indices that it's carrying, the S&P 500, and especially the Nasdaq 100, the IWM is paling in comparison. It's not been bad. I mean, off of the low back in April, we were down at 170 and now we're at 250. That's almost a 50% move in about 7 months. So this has not been a bad move. But again, everything's relative. I mean, if the IWM goes up 50%, something else goes up 60%, then you have a laggard. You have a relative laggard. So I think the IWM still looks really good. Technically, I think it's still in a nice uptrend. I believe it's got downside potential still to the low that we saw back in mid-October, maybe around that 238, 239 level. But I don't think you're going to see much below that level, and I'm not sure you're going to get down there. But that's a key level that I would be watching for. All right, mention the XLK and technology. I mean, honestly, this is what this market is all about right now. It's technology, just one word, technology. I'm watching this sector just go up. It seems like almost every day. We had that bad Friday a few weeks ago. I mean, that's in the rear view mirror. We went down under 280 and now we're all the way back up to 304, tacking on almost 10% since we hit that low. And that was just, 2.5 weeks ago. So pretty impressive rally by technology, no matter how you slice it. Scrolling down here, you can see technology relative to the S&P 500. This doesn't tell us it's going up. This tells us that it is absolutely exploding relative to the S&P. It is carrying the S&P 500 higher. Anybody out there who's thinking that inflation is a problem? Well, that is not what this is showing us here. Technology would be one of the areas that would be hardest hit from inflation. And you can see what's going on here. We've been going straight up since April on a relative basis, getting a lot of leadership in this group. It's really hard for me to be bearish the stock market when technology is performing so strongly. Within technology, we've got the semiconductors. Obviously, you can see the semiconductors making this big push above recent highs as well, breaking out. Look at their relative strength. When you've got semiconductors leading the market, technology is just going to follow suit. All right, if we look at the industry groups over the course of the last week, so I've got an industry group relative strength chart list that I like to follow. This is just an easy way for me to see what's been working and what hasn't in the market. And so over the course of the last week, you can see marine transportation. This group literally goes up and down like a yo-yo. I really don't like to trade it because it seems like once you get a little bit of strength, you jump in, the strength's gone, goes back down. You end up getting stopped out. At least that's been my experience. But I want you to concentrate on these next two areas, semiconductors, which I just mentioned, and heavy construction in the industrial area. Heavy construction loves the months of October and especially November. This year is no different so far, and we've still got the strongest month ahead for heavy construction. So let's take a look at that heavy construction index. And you can see we've kind of had a little bit of a cup almost, I guess, spanning a couple of months from late July to late September. Had a little bit of a handle down to the 20-day moving average. And then we broke out going into October, and we have continued to just pour it on here in this group. This is another area of the market that's showing a lot of leadership. I would be looking at some stocks in this space if you haven't already. I think this is a great area to trade. If we look at a seasonal chart, this goes back the last 13 years. So this spans over the years that since we've confirmed that a secular bull market is underway. Look at October and November. These are the 2 months where the odds of this index going higher are the greatest. October, 77% of Octobers have been higher since 2013. 75% of Novembers have been higher. So, and those are the two highest months. And look at the down here at the bottom, we'll zero in here for you. 2.6% average return in October, 5.9% average return in November over the last 13 years. So combined, 8.5%. Now, when you think about that, the S&P 500 goes up on average 9% a year for the last 75 years. Heavy construction goes up 8.5% just during October and November over the past 13 years. So this is a group you do not want to ignore. Certainly keep an eye on the group. If you look down at the bottom across all the other calendar months, the best outside of October was July at 2.1%. And then you got February at 2%. But October, November is the sweet spot for this group. And technically, it looks good as well. All right, for those of you who are unfamiliar with Earnings Beats, come on over to our website, earningsbeats.com. We have a 30-day free trial. Click that green button. You can get started there. Or if you just want to learn more about us, scroll down. We have a free Earnings Beats Digest newsletter. Name, email address, hit that subscribe button. You will be set up. Tens of thousands of folks have joined us. We'd love to have you join us if you haven't already. Just a couple more things and we're going to wrap up. I wanted to go through and just show you just the craziness of technology using an RRG chart. So here is a weekly chart, and this is just a stagnant where we stand right now, weekly chart. And look at XLK way to the right. Now, keep in mind, everything far to the right is strong relative strength. Everything far to the top side is strong momentum. So right now, at least from a longer term perspective, healthcare is showing the most momentum. XLK is starting to turn back up in terms of its momentum. But from a long-term perspective, there's no doubt this is what's leading us in terms of relative strength. The other two aggressive areas are also on the right side of the center. When you've got these three groups over on the right side, I don't want to hear about bear market. This is not Wall Street prepping for a bear market. This is Wall Street prepping for a continuing market advance. So wanted to point that out. The second thing I wanted to point out is on a daily chart, if you notice, XLK is turning back up on a relative basis. And the way you can see this even better is right now we have nothing in the leading, but probably within a day or so, we're going to have technology leading again. But if you click on any of the sectors down below, it will, well, actually, let me just go ahead and unhighlight all these. I think I had highlighted them earlier. So what you can do is you can just kind of go in and look at one at a time. Here's technology. So you can kind of see technology over the last 5 days. It was in weakening, slightly weakening, still on the right side. So still showing a lot of relative strength, but we just seen a little bit of momentum being lost, and now it's turning back up to the upside. Now watch some of these others, watch all these others. So here is utilities coming straight down. Healthcare, still weakening. Financials over here in the lagging area and weakening. Materials from improving back to lagging. Industrials moving slightly into that lagging area. Consumer staples was leading, now it's lagging. Energy showing a little bit of momentum to the upside. Communication services just kind of hovering, not really doing a whole lot in the improving area. Consumer discretionary, kind of the same thing. And then real estate, which had moved into leading and now turning around, moving back onto the left side. My point is, all of these groups, I think, are either in the wrong quadrant or are weakening, except technology. That's the only one. So it's just really standing out like a sore thumb right now. And some of you might say, well, that's not good. You know, we're not getting wide participation. This is where a lot of the market cap resides. I mean, if you're interested in the S&P 500 going up or the Nasdaq 100 going up, this is the group you want to see leading. This is the group you want to see going higher. I'm not ever going to be more bullish than I am when I see technology just absolutely crushing the way it has in recent months, and especially the way it has, or the way it did over the last week. All right, now, are we going to burst technology's bubble? I don't know. Microsoft reported after the bell tonight. Give you the latest, down $18. It's about 3.5%. We also had Meta, which I did not like. I'll show you a relative chart here in just a minute. Meta down $58, 7.75% after hours. Google, which I really liked going into earnings, up 6.5%. Let me show you what I'm talking about. I'll show you Meta. And you can kind of see the AD line just kind of going sideways. You know, it's been going sideways for a while. But look at the relative strength of Meta relative to the internet stocks. I mean, it's been a ski slope. It is way underperforming internet stocks. Internet stocks have been doing extremely well. Meta has not been participating. So going into earnings, I said earlier today, we have our live trading room on Wednesday. I said, I don't like Meta. I don't like the way it's trading into earnings, but I do like Google. Look at what Google's doing. Look at the AD line. That to me suggests possible accumulation. We're breaking out, so technically we look great. Look at the relative strength. It's the exact opposite of Meta. So money has been rotating into Google. It's been rotating out of Meta. And now we have earnings reports coming out. I did not look at the earnings reports, but based on the reactions, I'd say the relative strength gave us some pretty good signals going in. All right, that is essentially it. I will just show you the futures, just going to pull up the QQQ real quick. QQQ down $2, so about 1/3 of 1% after hours. So maybe we're seeing a little bit, you know, a little toll taken by a couple of those reports, namely that Meta report. Anyhow, I will be back next week to do this all again. Make sure you hit that like button and sign up, subscribe to the YouTube channel, to Stockcharts YouTube channel, and make sure you turn your notifications on. So whenever any of the events are posted, you can check them out. Anyhow, have a great rest of your week, everybody. Enjoy your upcoming weekend, and I'll see you next Wednesday. Happy trading.